Hello, everyone. Great to have you here for the workshop on revenue-based investing. We have a guest speaker, Luni Libes, who's going to be joining us. And as a part of this series, we're working on the question of how we're going to do outside investment into your company. And so sometimes that's a discussion from the investor point of view. Sometimes that's a discussion from the investor point of view, company point of view. And so we're going to share a very specific idea around this notion of how you can do a different set of deal terms that would allow you to engage in this. We have other workshops. I hope you all have taken a look at the Seattle Angel Conference website and the link off to the events that we're doing on the meetup group. We have stuff every Tuesday from now until the deadline at the end of August. So Luni, we were talking this morning at the open coffee about different pathways. And, you talk to your lawyer and the lawyer goes, Reg D 506B, and do angel investing and be done. And oh, by the way to do that is just do a preferred round and be done and simple. And there's so many more opportunities. So the question came up in the conversation this morning about different pathways. And so not only would I like to talk a little bit about deal terms and the revenue-based deal terms that you have in mind, but I also like to talk about different pathways to getting to a deal. So with that in mind, could you introduce yourself a little bit about why you're here talking about finance and revenue-based stuff and all of this kind of thing? And I'm going to turn off my mic and camera, and that'll let me disappear, and you'll be the only voice on stage. Okay. Thank you for coming, by the way.
You're welcome. Always a pleasure. I am going to, oh crap. Firefox cannot share screen without something changing. Firefox cannot share that whole screen. All right. Hold on one second. And I gotta not share everything. I have to share PowerPoint slide deck.
Yes, all right. Well, and just as
cannot allow permanent access. Oh, I can't remember it. Oh, is that the only problem? Okay. So can everyone see that?
Yes, we can. Thank you.
All right. So I'm going to answer your question, but I'm going to do it with slides because I like talking with slides. So welcome, everybody. Who am I? I'm a serial entrepreneur. So for some of you, I'm just like you. I started my first company here in Seattle in 1992. I did 5 software companies between 92 and 2011. 4 of them I started as founder or co-founder. 4 of them, not the same 4, were backed by venture capitalists. I did the standard dream that you read about in the magazines and the books and the movies. And I did fine, did well in that. And then I woke up. And I use the word woke on purpose these days. I woke up, I discovered that it was possible to do good in the world through for-profit business, as opposed to the Andrew Carnegie idea of get rich and then give it away. So I discovered that at a business school out here in Bainbridge Island called Bainbridge Graduate Institute. And I wound up teaching there for 8 years. And while there, I started a business accelerator, which is also an investment fund called Fledge. And that name will pop up a few times in this conversation. And so we're kind of like Techstars, except we do impact companies. We do companies that make a big difference in the world, and we invest in a very different way, which is kind of the topic here. So now I'm an investor. So if you're not an entrepreneur, if you're an investor, hey, I'm just like you too. And we do early stage stuff. So we do all investing that looks a whole lot like angel investing. And I've also done a nonprofit and written a whole ton of books and done some podcasting. And that's all those other logos on the side. And a teeny bit about Fledge. So as I said, it's a business accelerator. It's actually a network of business accelerators. All these logos on here are partners. Seattle's the one I run. And we run a program. It's 2 months long. We bring in entrepreneurs from all over the world. Everything is colored in. We work with them for 2 months. We make them better. We invest in them. We send them home to grow. And one other thing we're doing, and I'm going to take my opportunity here to pitch, is we launched this year the Angel Accelerator in partnership and with John's help, based on the learnings of the Angel Conference. And so what we did is we found a bunch of we found a bunch of investors who were willing to put in $10,500 each, so bigger ticket size than the Angel Conference. But each of those tickets bought a share of 7 investments. And we met for 2 weeks in February. And then we were supposed to meet for 7 weeks in person, which has turned into 15 weeks online. So far, we're probably going to meet for 52 weeks. Those angels picked the companies that came into the Startup Accelerator. We're running one of those at the same time. And those investors learned how to make those investments. And now they're learning more details about investing, fund management, and portfolio management, because they have 7 investments, not 1. And they're also mentoring the startups. So we'll be doing this again next time the world lets us do a Startup Accelerator. All right, any other questions, John, before I jump into the topic? And I can't see the chat window because I'm sharing screen and slides. So if somebody needs to interrupt me, just interrupt. All right, tonight we're going to talk about the seed stage of investing. And the stages of investing, we don't have any consensus about what to call those stages or where they are or whatnot. This is my ontology of stages. And so there's that first bit of capital that you're not going to get from outsiders. That's a friends and family thing. You might get it from crowdfunding. Then there's this stage at the point where you can go out and get angel investments, either individual or through groups, or seed funds, which kind of act like angels. That's also the stage that we call the valley of death. And we call it that because if you don't jump over it, your company never really takes off. And then once you're up and running and you found product market fit, you have growth capital. And what I'm going to show you tonight works in growth capital. Actually is used more often in growth capital than seed capital. But I'm an entrepreneur, so I do all my work in seed capital. All right, we're going to go back in time. We're going to go back all the way to the 60s, the early 60s. And we're going to go back to that era because one thing that I've found in explaining this to people and in talking about fundraising for venture-backed startups is that everybody just assumes that venture capital has been around forever. And it hasn't. Venture capital, the way we do it today, the way that the Sequoias and the Draper Fishers and whatnot do venture capital was invented about the same time as Beatlemania. And we actually know who invented it. So on the left here is George Deroe. I don't know how to pronounce his last name. I'll call it Deroe. He invented venture capital. He was originally a financier, and then he became a teacher at Harvard. And 2 of his students, Anthony Rock and I don't remember Davis's name, Rock and Davis, they created the first real venture capital fund. And they did that in the mid-60s. And they invested in Intel. That was a startup in 68, I think it was. And it was a really hot startup. And their venture capitalists were Rock and Davis, who put in tiny amounts of money because the venture capital industry wasn't big. It wasn't a billion-dollar industry until the late 80s. It really wasn't a real major important industry until the 90s. And then they screwed it up with the dot-com bubble. We won't talk about that today. This is an industry where we know a lot of details. It's a very well-tracked industry. And so here I pulled up the latest numbers. So we have the 2019 numbers, and you can probably find the Q1 numbers online as well. But we know exactly how many venture capital deals were done. We know how much money was raised. We know pretty much everything about the venture capital world in terms of numbers. We're going to talk a lot about numbers. And we know pretty much everything that goes on in the angel area as well, or the angel and seed space now, since all these seed funds have popped up. They're kind of in that same space. So we know how many companies got the first check last year and how much money that was and how long it's been taking them over time. That's the middle graph here to get from round to round. Now, that said, nearly all that money, 99.9% of all that capital that gets put through the venture capital and angel systems is based on this book, which is really strange because this is a book about the history of science. This is a book that's used by philosophers. It has nothing to do with finance. And when I do this in a room and I ask how many people have read this book, usually, out of the 100 people in the room, maybe 1 or 2 hands goes up. Because it's a pretty obscure book. But nonetheless, every single one of you knows what was defined in this book. because this is the book that defined the word paradigm. And we are stuck in a paradigm. The reason why not enough companies get funded is because of a paradigm. And the definition is pretty simple. It's a set of beliefs, and when you get a piece of evidence that does not agree with those beliefs, you ignore it. And so that book, The Structures of Scientific Revolutions, talks about the fact that there was proof, there was mathematical proof that the Earth went around the sun, but it was ignored for hundreds of years because it didn't fit the paradigm. The paradigm was the Earth was fixed in place and everything moved around it. And so what we need to do, and what I've been advocating for years now, is we need to shift the paradigm in early stage investing away from the way it's been done since the 60s to a totally new method. And by the end of this presentation, you'll understand what that method is, and you'll have a chance to actually try it out a little bit. And so the antidote to do this, and the rest of the details that I'm not going to cover today, are covered in this book. It's The Next Step for Investors, Revenue-Based Finance. For those of you who are entrepreneurs, the Next Step series is a set of 6 books that I used to teach for 8 years on how to do business planning, how to do everything you need to do from idea to revenues. And then there's a few more books after that. This one's for investors. All right, I said we know a lot about this industry. So what we know from the Kaufman Foundation and Small Business Association is exactly how many new companies get created each year. I didn't pull up the exact number. It's 560 something thousand. Let's just round it down to 500,000. There's been over 500,000 companies started in the US every year for the past 30 years, at least. All right, we know that a lot of those want funding. Not all of them. Not all of them are venture scale. Not all of them need funding. But a large number of these companies, tens of thousands of companies, go and seek venture capital funding every year. And last year, 2,766, plus or minus 10, 2,766 got a check for the first time from a venture capital fund. That's according to PitchBook, same report I pulled up those graphs from. Now, every single one of those investments, and it was up a bit from 2018, and it was down a bit from, it has its ups and downs, but it's, approximately, 2,500 per year, and that's been pretty steady for 20 years, 20 years. Every single one of those investments was made inside this paradigm of, I need this company to grow really fast and then exit. Right? That's the term of art, exit. Exit being acquired by another company or IPO. And you've seen the IPOs in the news. They're pretty rare. So more or less acquired by another company for a lot more money than the investors put in. That would be a good exit. And so we know, again, from PitchBook, that in 2019, only 882 had exits. Right? And so this wasn't the ones that were funded in 2019. This is the ones that were funded in years past. But of the 2,500 or 2,700 that were funded, most of them didn't have an exit. Most of them will not have an exit. What's crazy in looking at this industry is here we have this huge pile of companies, 500,000 companies a year just in the US, and less than 1%, it's like 0.47, I think it was, less than half of 1% are actually funded by venture capitalists. And less than 0.2% of all these startups actually have an exit. And yet, when you look at the terms that are used in every angel investment, nearly every angel investment and nearly every venture capital investment, they're just assuming there will be an exit. And there won't. The odds are there won't. And yet they're investing as if it will. So something's wrong there. There's a mistake in the system. There's a flaw in the system. And again, I'm going to show you a fix to that. The consequence of this paradigm is that when you talk to the partners at Madrona or the partners at Pioneer Square Labs or Flying Fish or Founders Co-op or any of the funds that are doing this investing, or Alliance of Angels or E8 or any of the other angel groups, they will tell you that almost every company that starts up in the country is unfundable. And I put unfundable in quotes because they're not unfundable. They're not unfundable as in there's no possible terms you could use to fund them. They're unfundable as in the terms that are typically used don't work for, you just saw the numbers, they don't work for 99.8% of all the companies out there. So I say, fix the terms. Don't change the companies. Pick a different set of terms. All right, so here's what the paradigm is. Right? So in order to fix it, you have to understand it. So here we are at that seed stage, and the company has some value now. So that's the dotted line at the bottom. And when an investor comes along and says, I want to buy some percentage of this company, they'll do it only if they think that the value at that time of exit, which is an unknown time period in the future, but 6, 7, 10 years later, if that value in the future is at least 10 times more than the value is now. And if it's not, they will pass. They may not tell you they're passing. They may tell you some other excuse. They may tell you it's nice, get back to me later or whatnot. But if they're not saying yes, then one important reason why they're saying no or not saying anything is because they're not seeing that believable 10x return. And so the question is, where's the 10x come from? And I'll tell you, this number 10x is so prevalent in the industry that it's just shorthand for, for good. I was teaching years ago, like a dozen years ago, they invited me to teach at a continuing ed class for startup lawyers. And that it's kind of a scam. Lawyers have to take a certain number of hours of continuing ed, and they had people like me teaching them. And Chris DeVore from Founders Co-op, and Greg Gottesman from Madrona was there back when he was at Madrona, and Jeff Entris. And it was kind of organized by Jeff and his friends to teach the other lawyers. And so practitioners like me were there to teach. And I stayed because it was kind of interesting. It was 8 hours long, and the word 10x showed up about every 3 minutes for 8 hours. And the word exit showed up in between those almost as much. Okay, so why is it 10x? And this chart actually comes from Jeff Entris. If you don't know him, he was the most prolific angel in town. Now he's a partner at Pioneer Square Labs. Okay, so here's where 10x comes from. This is what a successful angel or venture capital portfolio looks like. So you're told, if you go through the training, they'll tell you got to do at least 15 investments, maybe 20, 25 is better, but the numbers will just do it out of 10. So for every 10 investments you make, if you're going to succeed using the current paradigm, then 1 out of 10 times you need a 10x. So 1 out of 10 times you'll find that 10x, if you're successful. And if you're not successful, you won't. And then 2 out of 10 times, more or less, you'll get something that an investor will say is okay. And in baseball terms, it's a double or a triple. Okay is 5 times your money back. Just to be clear, that's a $100,000 check gets you $500,000. That's not great. That's just okay. Great is you put $100,000 in and you got $1 million out, or $1.2 million or $1.4 million or 2. All right, 3 times out of 10 you get your money back. And it's usually exactly your money back because of the preferences. And 4 times out of 10, you lost your money. And so the weighted average of that is 2.5-ish, 2.3. We've seen some research. 2.6-ish comes out of the research. Somewhere between 2 and 3, somewhere in the middle. What's really interesting, again, if you step back and look at this paradigm, you notice that successful VCs who get to see 10,000 investments before they put their portfolio together, they're only right 3 out of 10 times. 30% of the time, more or less, 32, 35-ish, 3 out of 10 times, they've actually made money. And the other 7 out of 10 times, they've lost money. And you can sit there and argue, hey, they got their capital back, but it could be 3, 4, 5 years later. So they've lost money. They should have put it in the bank, in the savings account. They would have made more money. That's the paradigm, okay? And so they're not actually searching for 10x. The real story here is that 10x is a means to that end. What they're really searching for is 2.5 times their money on all of their investments together, on their portfolio. And this is, again, why we suggest you need 15 or 20 investments, because you're probably going to lose 7 out of 10 times or more as an angel. So you got to have a lot of bets out there so that you can, if you're going to stick with this paradigm, so that you have a chance to succeed. Okay? And again, I'm going to show you something that you don't need to do this. The real reason is 2.5 times your money over a 10-year period is 15, 20% IRR, depending on when you get paid back, which is better than the S&P 500, and let's ignore this year as a benchmark for that. But 15% is way better than the historic S&P 500, and that's the actual goal here. The goal is risk versus reward. This is much higher risk, so I better have a higher reward than the S&P 500. That's ultimately what it boils down to. And so that 10x is simply there so that the numbers work out that you can beat the S&P 500. That's it. Okay, so that all aside, let's talk about how money actually gets invested in companies and a little bit more about what doesn't work. All right, so I have a few diagrams here to go through. In these diagrams, they're not quite to scale here. The green block is the money that you as the investor are handing to the company, or if you're an entrepreneur, it's the money that the investors are handing to you. Either way, same thing. The gray line there is the growth in revenues of the company. We're looking at the early stages of the hockey stick. And if you're talking about debt, right, traditional bank-like debt, well, then here's what the terms are. The investor gives money to the company, and the company promises a bunch of payments back to the investor that add up to that capital plus some more, totally irregardless of how the company's doing, right? Just based on a set schedule ahead of time. And the reason we don't use this for startup capital is because it doesn't work. Because the first few payments aren't really affordable to the company because they haven't grown. The amount of money they need to grow is large. The amount of money they're earning is tiny compared to where they're going. And so the first few payments just don't make any sense. And then the total return to the investors also doesn't make sense. I just showed you that the investors want 2.5 times their money back. That's a 250% loan to get 2.5 times their money back if every single company pays them back. So if some of the companies fail, then it has to be higher than 250%. So imagine asking a company to pay you 400% interest. Can't happen. A, it's illegal, and B, all the payments are unaffordable at 400% interest. So just because of that, we don't use debt for early stage companies, and ignore the fact that convertible debt is called debt. It's not really debt. The normal way to invest in a startup is preferred equity. And on this chart, equity looks really strange. So an equity investment is, again, the same green box. The investors hand money to the company, and the company promises nothing. Right? Future promises of wealth. But in terms of cash flows, the company's promising nothing. So the company's going to take this money and start to grow, hopefully. And someday in the future, at an unknown time, somebody else, some other company, is going to hopefully come along and buy the company for at least 10 times what it was worth at the beginning. Right? That's the success story. But as we just saw, most of the time there isn't that success story. And so most of the time, either the value goes to 0, that was 4 out of 10 times, and the other 3 out of 10 times, this hockey stick doesn't happen. All right, and 3 out of 10 times we had 1 10 and 2 5s and 3 1s. Well, those 3 1s, yeah, there's no easy way for the investors to actually get their money back. So a lot of the zeros aren't dead companies. A lot of the zeros are zombies. They're companies that are still running but really don't have any value to the investors, and there's no way for the investors to get their money back out. They just get written off. And the 1Xs, they're kind of mercy acquisitions. They're acqui-hires. Let's buy the team, but we don't really care about the product. So that's usually the only 2 ways that anyone ever talks about startup investing. There is a third way. And I did not invent this third way. I found this third way out there in the world and then adapted it and have made it made it work. So the third way, in Seattle, we call it revenue-based finance. In other parts of the world, they call it royalty-based finance. There's lots of names for this, but we're in Seattle, so I'm calling it revenue-based finance. Here's the chart. The investor hands, again, money over to the company. And now what the company is promising is a percentage of their revenues. So there's a fixed percentage of the revenues that they're sharing back to the investors on a regular basis, and they're promising a specific amount of money to be returned, right? Not a certain amount of time, but a certain amount of money in total to be returned. So the investors don't know how long that's going to take. We get a guess, and I'll show you how to do the guess. We have a decent guess on how long that might be, but we do know how much money it will be. So we don't know what the return is at the beginning. We don't know what the computed internal rate of return might be on this investment, but we know how much cash is coming back if it succeeds. And the positives of this is that every single payment is possible from company to investor because it's a percentage of revenue. So they earn the revenues. And it's a small percentage. It's a single-digit percentage. This can be done in a variety of ways. The two most popular, actually the absolutely most popular way to do this is revenue-based loans. And a leader in the field of this in the entire world is in Seattle. It's where I discovered this at all. They're called Lighter Capital. And so they structure this, and it looks like a loan on their books. It looks like a loan in the company books. So, for example, right, everything in bold is a variable here. So, for example, let's say you were raising $100,000, and you can just do increments of this if you're raising more. $100,000 goes into the company, and the company then promises 5%. Could be 2%, could be 7%, some single digit. Promises 5% of the company, 5% of the revenues on again, monthly is a variable. Month is pretty common in revenue-based loans. And a total return of, in this case, $200,000. Lighter their multiple, this is a multiple of 2, right? 200 divided by 100 is 2, it's pretty obvious. Lighter would do 1.8-ish, plus or minus a few. They might go as high as 2, they might go as low as 1.5. So it could be, $150,000 investment returning 210. And then you can't do that math in your head. The way I typically do this through Fledge is revenue-based equity. And this is not exactly the numbers we use, but it's the same structure we use. So again, I'm just going to show you in $100,000 increments. We would take our $100,000 and it would buy a certain number of shares. And that certain number of shares is a percentage of the company. The percentage is almost superfluous. The company then promises to buy back some number of those shares. We happen to use half. We use half because we talked to Jeff Ventris way back when, and he suggested half, and we said sure. So we're using half. And it's half for a certain amount of money. So here I'm just penciling in $200,000, a 2x return, which is what we use. It's a very common number in the realm of startups. And how you determine how to buy those shares is a percentage of, and we use quarterly revenues so that we don't have to do as much paperwork. It's really the only reason. So we're doing quarterly repurchases of our shares instead of monthly, but it's the same thing. You just take your last 3 months worth of revenue, you multiply that by a single digit. We tend to use 4%. I think I'll show that in the next slide. And that then divide by the share price that we agreed to. And that's how many shares that get repurchased. So literally, we run out of shares for them to repurchase when we've been handed $200,000. We've handed them back half our shares. And that gets us a 2x return on half the investment, which gives us an upside on the other half of the investment. And then we do a put option on the other half. So we have the right to ask the company to buy back those shares after 5 years for terms to be determined then for the value of whatever the company is then. So we're actually aiming for a 3x return, but we bake in a 2x return. And these are our exact terms at the moment at Fledge. So we're an accelerator. So what's accelerators do? They hand $20,000 in cash to companies, just like Techstars. We tack on the cost of running our program in this investment, which turns out to be $17,500. So we spend $37,500 per company. It buys us 6% of the company. They buy back 3% of their company for $75,000, 2 times 37.5. And we use 4% of revenues to determine how fast the buyback. And it typically takes 5, 6, 7 years for our buybacks. All right, so, and there's other ways to do this, but debt and equity are by far the two most popular. And so it's really comes down to, besides how much to invest, it really comes down to 2 major variables. What percentage of revenues is the company going to share? And what is the total amount of cash back? And so for seed stage, 2 or 3x is kind of normal. I've seen 4, but that's getting a little greedy. And at growth stage, actually the slides are kind of out of date. 1.5 to 2 is kind of normal. And we've seen concessionary deals for highly philanthropic programs that might be 1.2. So I want 20% extra back. I haven't seen 1x's. And so why do you pick debt or equity? Mostly comes down to taxes. The main part is that interest on a loan is tax deductible. So if you have a growth stage company and they're paying taxes, right, because they have profits, they can take off the interest. They can take off the payments above the principal, and they can take that off their tax return. And if we're investing in a seed company that's not profitable yet, isn't paying taxes, well, then the gains on our equity are capital gains, and we get a lower tax rate as investors. So one side or the other should take a better tax rate. The other reason we use the equity in pledge versus debt, besides the early stage and the taxes, is we don't really want 2x. We want more. We want as much more as we can get because we're helping the companies when they're really young. And so by having half the shares repurchased, it makes it really easy for us to have upside. But I've seen a lot of these deals done as revenue-based loans with warrants, which does pretty much the same thing. Some other things you can pick. These redemptions, they can be optional. So I've seen deals on both sides where the investor can say, skip it. I don't want it this time. And I've seen deals where the company can say, it's our option. We'll pay it if we want to, and we'll hold on if we don't feel like it. It gets tricky. It's much better to make them mandatory, in my opinion. But I have seen the optional versions. And then every other preference that you ever see in a preferred equity deal can be tacked on here, and I've seen that as well. All right, and if you do this, if you follow this new idea, and okay, it's a new paradigm. If you follow this new paradigm of investing based on revenues instead of hoping of a future acquisition, turns out that every single company that earns revenue is investable. As long as they're earning revenue, may not be as much as they want, but given the right investment structure, and the right amount of revenue, every company is investable. So let's put one of these things together. All right, so let's do this. I'm going to pitch you 4 companies, and I'm going to, as you're hearing these, it doesn't really matter which one you like. I'm just giving you 4 companies so you have something to think about in terms of what an investment would look like. And the 3 questions you should have in your head. So just assume you've done the due diligence, you like these companies, you love the team, right? You want to make an investment in 1 or 2 or 3 or 4 of them, doesn't matter. First question you should have in your head is, what kind of return do I want? And in this style, you can actually tune it. You can decide. It's kind of like debt. You can say, I want my 15% IRR. Or you can say, there's too much risk here. I want 20% IRR. You can keep going higher if you want. Second one is, how long do you want to wait for the money to come back? That will change your IRR a bit. But that's a question that you can, again, bake into this deal, which you can do with debt, but you can't do with equity. And then what else is important to you? What other of these normal preferences do you require on the deal? Yeah, 1 second here. So I'll let some amazing growth sink in on you. This is a real company. These are their real revenues. I'm really proud of this one. It's a pledge graduate. We met them in 2018, halfway through the year, before they did the $500,000 year. Okay, so just imagine this company's in front of you. And let's just imagine it's 2018. And so they're predicting $1.2 million next year. And then they're predicting even more growth. And it might, maybe not quite as fast as the early stages. This Obri Tanzania, by the way, they make cooking oil. They're in Tanzania. They buy sunflower seeds from small farmers in Tanzania. They work with like 350 women farmers. They turn it into sunflower oil and sell it to distributors. They don't sell it all the way to the retailers. They sell it to distributors and they're done. They're the only producer of sunflower oil in the country. It's a $100 million market, so there's plenty of growth opportunity here. And their competition is all imports. Their product's half the price because they don't have to do the shipping. Little Gray Farms, this is another fledgling from a few years back. They're based here in Seattle. They're the only producer of escargot in the United States. If you ever ate escargot in the United States and you ate it in Europe, and you wondered why it was so much better in Europe, it's because every single snail you ate in the US came here in a can. So we're going to fix that. They were about to launch before the pandemic hit. Or maybe you like to drink really lovely spirits. This is Santo de Piedra or Agua Piedra Mezcal from Oaxaca, Mexico. They make a lovely handmade mezcal. Some third generation mezcalieres make it. It's in hand blown glass bottles, sold in really lovely places in Europe, a few US cities in Asia, $80 a bottle, doing really well. Or maybe you like to save the environment. This is ArcLight, originally based in Buenos Aires. They take any plastic waste, they turn it into artificial stones for use as drainage or inside concrete. So they're replacing quarry stone with plastic trash, any plastic trash, doesn't matter what number it is. First facility is up and running, Buenos Aires. Second one is under construction in Los Angeles. Okay, just 4 fun companies to talk about. So again, you like one of those, it doesn't matter which one. You've done all your due diligence, right? If you haven't had that lesson yet, it's coming up. Let's just say that the ask from these companies is $350,000, because that's where the numbers come out to be a nice example for you guys. And let's just round the revenues. Let's just assume they're all the same, which they're not in real life. But let's just take the Obri numbers, round them more or less, and say, here we are this year. They're expecting to do $500,000 this year, and then they're going to double next year to $1 million. In year 3, they're going to add 500,000, so that's a lot slower growth, but still growth. And then to 2 million, 2.5, 3. So I just made it $500,000 more each year, which is what real companies do, by the way. That hockey stick that you guys either see as investors or create as entrepreneurs almost never happens, right? Those are the rare exits. What usually happens is you wind up peaking at some point or slowing down your growth. So I did a realistic set of numbers here on what's probably going to happen with all these companies, which is their growth will slow year by year, but it's still, we're talking about a $4 or $5 billion company at the end of this progression. And I have a typo here. Year 9 is 4.5, year 10 is 5. All right, so here's what I really do. This is the spreadsheet that I actually use to do these investments, and I'm going to take you through it step by step. So it looks a little complicated to start with. So just at the very top of the spreadsheet, and it's downloadable. John will send you a link when we're all done here. So at the very top, we have how big is the investment, and what multiple do you want from this investment, and then it calculates it on the side, because again, it's not always a round number. You can't always do them in your head. So here we got $350,000 investment, a 2x return, simple $700,000 back. Then on the left side here, and it's an annotated spreadsheet. I'm not showing all the annotations, but there's one on the bottom there. So here we have 10 years of projected revenues. So what you do is you type in what the company thinks, what the company's promising its revenues will be for the next many years. Usually you don't get 10 years of projections. Usually you get 3 or 5. You can do your own projections past that. And then what I do in real life is I usually tweak these and I say, okay, entrepreneurs, they're a little bit optimistic. I will take their numbers and I will drop them down to what I think is reasonable. And I'll put that in here as well. Sometimes I'll do this on 2 tabs so I can compare the two. It really doesn't matter. All right. And so we have this growth rate computed in column C. You can see it slows way, way, way down. Okay, so that's column C. And that's just year by year differences. And then we have 4 scenarios. So what we remember, we're trying to figure out what percentage of revenue to ask for and what multiple we want. So we're just going to fix the multiple at 2 because that's kind of normal for seed investing. We're not going to play with that one. We're just going to play with the percentages. And that's usually what happens here is you tweak the percentages, and then if you don't like the results, you might tweak the multiple and make it 1.8 or 1.9 or they don't have to be round numbers, but you might play around with that. So let's just take scenario 1. We're just going to guess that 3% of revenues might be a good thing. So we have in year 1, it's a negative $350,000 investment. So we're computing an IRR here. So it's $350,000 out. And we're doing years instead of months or quarters because it's quicker. The IRR will be off a little bit, but it's close enough. So we have $350,000 leaving us and going to the company in year one. And then 3% of $500,000. So 3% of $500,000 is $15,000. So at the end of year one, in sometime in year two, you will get paid 3% if you make this investment, 3% of last year's revenues, and that's $15,000. And then $30,000 is 3% of $1 million, and then onward down here. So 135 is 3% of year 9. And then the sum total of this green area is right here, and it's $675,000. And at the bottom here, we're seeing that it's 1.93% of the original investment. And we're computing this because, lo and behold, 10 years went by and we didn't get our 2x back. The IRR is still 11% on this. So if we got this cash flow, we would be earning 11% on our money, which is nice, but it's not high enough. I told you before, we're trying to get to 15. And so this one really doesn't work out. Either this is too much money, but I don't know about you. I'm not patient enough to wait more than 10 years to get paid back. So to me, this is a failed scenario. Let's move on. So let's try 4%. Doesn't have to be a round number, but those are the easiest ones to start with. So we just go up by 1. And so now the green area is, again, just 4% of these revenues over here. Although you can see at the end here that this last payment isn't any bigger than this one, even though the revenues went up. The spreadsheet knows what your max is. It knows what this value is, and it just doesn't let you get past that. Right? That's the deal. Certain amount of money back, not 4% forever, 4% until $700,000 is paid back. So some of this is $700,000. That's a 2x return. IRR is 13.9. We're getting close to 15. Takes 9 years to get paid back, and we can just kind of feel that this was 140 and this is 140. It takes a full 9 years to get paid back. Maybe if this was monthly, it might be October, it might be November, but it takes 9 years. That's a long time as well. So let's try 5. So we get to 5%. What happens if you do 5%? Well, again, now we're seeing that in year 9, it's 0. So we're done sometime in year 8. It takes 8 years to get this back. We hit the magic 15%. Not super magic. It's just, again, bigger than the average S&P 500. Well, let's just do one more, just for fun. And so 7. Let's just jump straight up to 7 and see what that would do. And 7 gives us 1 year quicker. So again, we have this thing going on where it maxes out. And we're at 18. So if I were to do this deal, literally, I would just type in those revenue numbers, the 3, 4, 5, 7. It would already be in the spreadsheet. And boom, I would just glance at this and say, well, that doesn't work. That's too long. The answer is somewhere between here. Can I live with 5? Is this good enough? Or do we need a little bit more? Maybe the answer is 6 in real life. Maybe 7 looks good to me. Maybe 7 years is a nice amount of time. This isn't 20. It's not ridiculously high. Let's try with 7. And if they push back, we can go to 6 or 6.5. I know I have some negotiation room. The answer is somewhat more than 5 and somewhat less than 7. And done. We're done. That's it. That is, as long as we like the company, that's really all we have to do to figure out what the right amount is. So I want you guys to chime in, and I'll figure out how to undo the screen share here in a second. I want you to do this in the chat window. So I want you to just take a moment and think about one of those deals, doesn't matter which one, and think about, well, would you do a revenue-based loan or revenue-based equity deal to invest $350,000 in one of those companies? Which percentage of revenues would you ask for? And I'll put up that spreadsheet again so you can see it. What return would you want? And you can eyeball and kind of feel for that if 2x is not your ball of wax. And then what preferences do you want to add to the deal? Do you need a board seat? Do you want a whole bunch of covenants, investor approvals? Do you want to right of first refusal? You want pro rata share if there's another round? We can talk about how rounds work. Do you want to give them a year before they start paying you? Or do you want to give them until some other milestone happens before they start paying you? What happens if somebody buys this company? Do you want any warrants if you're doing debt? Do you want anything else on the deal? And so the way I usually do this when we're doing this in person is really simple. You're all competing. So I'm going to take the position of being the entrepreneur, and I'll just represent all 4 companies at once. And you guys are bidding your best and final offer to invest in this company. Again, it doesn't matter which one.
We have
the
ability to break up into tables. And so what I would like to do is to start the presentation part, have them go into the tables, have a discussion about that. And each table is a syndicate that is trying to get your deal. And so we'll have this discussion and spend some time on that. I'd like you to post into the chat the spreadsheet so they can open it up on a side window. And then if they click on the table under more, they can get to a whiteboard. And so they can sort of doodle with each other around various topics if they want to. And that'll let you have a chance to look at the chat window and see the questions that have come up. And that'll give them time to work on that. So how much time do you think would be a reasonable conversation to get to an answer?
We usually do it in like
at 7:20. I will bring everybody back, and Luni will post into the chat the spreadsheet. What I would like each of you to do is gather at tables so you have critical mass. So at least 4, preferably 5 people per table. If you leave one seat open, then other people can come in, like Luni can stop in and visit and have a conversation. So gather around the tables in the first row, and then introduce yourself around the table so everybody can see each other. Remember, on the bottom left corner, you can click on the tile view and get big pictures so you can see everybody big. And if you click on somebody's face, you can expand it so they're the only one talking. So let's do that engagement now. Everybody move to the tables and take a look at this and do introductions. And then the link should get posted here in a sec. Hello, everyone. Welcome back to the presentation. I hope that all of you have gotten what you need to come to a decision about what you're going to offer the company and make it go. We're going to get Luni up here and have a conversation about what you want to do. Please pick somebody at your table through chat so that we know who to call up the stage when you make an offer. So Luni, go for it.
Hi. No, I'm so somebody come in and John will send you up here and we can chat about your terms. Again, we're just looking for debt or equity.
Right. Raise your hand if you want to come up on stage. Otherwise, I'll randomly pick people.
The negative of this versus Zoom is I can't see you. All you are is chat to us at the moment. Unless there's some other thing to click on.
You have to look at the chat to see who's there that can come up.
Yeah, I don't know. In the virtual version, it's hard for us to say like finish up in 2 minutes.
Right.
All right.
Oh, we did say finish up in 30 seconds though. Satya, what kind of offer would you like to make to Luni?
Yeah, it's very similar to the one you showed on the slides. So we would like to request for 10% of the company, and half of the shares will be bought back using 6% of the revenue. There is a honeymoon period. The buyback starts at either the 3rd year or when the company hits $1.5 million in revenue, whichever occurs sooner, until the 2x payback.
Okay. So given you're skipping the year with $500,000 and the year with $1 million, it'll take another 4 months to get paid back, more or less.
Yeah.
Yeah. Okay. Well, that seems like a good. And anything else? Since you're an equity investor, you need a board seat.
No, we haven't talked about board seat.
You didn't get that. Okay. All right. Well, that's
what about information rights? What about liquidation?
We did talk about pro rata rights, but we did not quite get to how to apply that here. because we still will be holding on to half of the shares. How does pro rata apply in this case if there is a future funding round?
10, yeah, yes, I get it. I'm actually not going to go through all the details now because it's going to mess up. It's going to make other people change what they're going to tell me. So I'll get back to you after I hear the next 2 hours.
Yeah, thank you.
Okay, cool. So we're going to take you off stage and then call for other people. Other people, raise your hands, please.
In the chat window, it says Martha will do it. Surprise. Zahar has his hand up too.
Martha should be able to get on stage. I'll have to figure out how to do that. Sorry, Zahar had his hand up.
Zahar has his hand up.
There we go.
I'm back. Okay. So I.
Wait a second.
I'm here.
There we go.
Okay. I'm here from table 3. We spent quite a bit of time talking about the different things we want. So we would love to offer 5% equity financing with the opportunity to buy back half of that.
Oh, let me freeze this. I like the 45-page proposal or the 145-page proposal. That's a term sheet.
Zahar, you're locked up. Is your connection still going? If it is, you may need to reset your browser. Oh, there you are. You're
Sorry.
back.
Sorry, I was going through the whole thing and realized you guys can hear me. So I'll start from the beginning. So we're offering 5% equity, half, 2x return, and half of that would be bought back by the company. We would love a board seat, as well as we are offering honeymoon period for the first year. We felt like 500,000 in revenue wouldn't be enough necessarily to position the company well for future years. So, if they have to pay a certain percent of their revenue during the first year, just didn't make sense to us. And then that would be in place unless they exceed that revenue. So if they're exceeding their revenue goal for the first year and they're generating more than 5K, we could look into basically them, paying on just that difference of the revenue between the 500K and whatever they're generating. So that was basically the idea.
And what was the percentage of revenue?
5%.
5. Okay. So I just want to point out, so that sounds slightly better than the first deal at first glance, except they had a longer honeymoon. This is a little shorter. Just in terms of numbers for everybody's piece, like the honeymoon of 1 year is really saying, let's skip the first $25,000 of payment, assuming the $500,000 comes in. And so in the grand scheme of things, when we're talking about a $350,000 investment and a $700,000 repayment, $25,000 really shouldn't move anything. And so if this company really is going to get to $5 million in revenue on this $350,000 investment and no money after that, is it really worth the complexity of negotiating the honeymoon? Because it's a term, so you might get pushback on that. And it's, even as the entrepreneur, it's like, okay, I'm going to take it. But with my investor hat on, I'm going like, why are you bothering to do that? To push $25,000, into the future? Is that worth the trouble?
Changes your taxes.
Yeah, well, it could be. We had at least one lawyer on this group in this call. It could be that we really want to get all the way out past year 5 because then you get 0% tax rate on small qualified businesses. So maybe you want to do a 5-year honeymoon just so that everything is tax free. Personally, I like to get paid. You'll notice when you play around with this spreadsheet, you'll notice that the IRR goes dramatically different. If you simply push things in the future, your IRR will go dramatically down because IRR is heavily based on time. The sooner you get paid back, the higher your IRR.
One thing I would say, Luni, you said, like, is it worth it to negotiate something like this? I think the first year as a company and you're not you don't need to pay $25,000 to investors. That $25,000 might be worth so much more to you as the company at that point, because you're able to test so many different things and you're able to do something that you wouldn't be able to do otherwise. And in some cases that could make or break the company and position so much better for the longer term. So I think that's just from the founder's perspective. I think that's the one where I feel pretty strong about it.
I hear you. I used to be, I still am an entrepreneur, but I used to be a young entrepreneur too. And I totally understand how hard it is to raise money. So I totally feel for you there. Just in these terms, I've learned that simpler seems to be better. And so if I do a deal and it's just, here's the percentage of revenue and here's the multiple, and it starts next quarter, one thing that we've done in reality, and I'll mess this up for the last team that's going to present. One thing we do in reality is that when the time comes for that redemption, in the early years, our answer is usually, because the first payment's usually small. If it's $25,000 for the entire year and it's ramping up like that, then the first quarter of payments might be, $7,000 or $8,000. So I may simply go on the first quarter, hey, let's just wait till next quarter. Pay us next quarter. So the terms have no honeymoon, but in reality, and the terms are mandatory. The terms don't have any options in it, but it doesn't mean that you can't, as an investor, all of a sudden be nice and say, let's push it into the future, because why bother for $7,000? And in real life, the number's usually smaller, right? We're usually younger companies, so the first payment's usually $800. Let's not bother for $800. Let's wait till next quarter. It'll be more than 1,000, right? And then we'll get to 2,000, and then we have some real money to play with. So we do that a bunch.
Can you let us know where to find those nice investors?
They're all in the impact world. They're all the investors like me that are trying to make the world better through capitalism. Yeah, you don't find them in the tech world.
Yeah.
All right, thanks, Sahar. We got one more table at least?
Do a little plug for SoCap while we're adjusting. Everybody who has left to come on, please come on. Actually, Martha, would you please turn on your video and your mic? On screen.
Whoa! There I am.
So there you go.
Okay.
All right. Do we have a dissenting view? Do you have something different to offer?
We do have something different to offer. We did not finish our discussion. So equity, we're interested in pro rata. We want a board seat, 6%.
Okay. So it's interesting. We all came up, the three tables came up with about the same answers. And when I do this to the impact investing crowd, which I have done a dozen times at least, I get vastly different answers. So one thing I've learned, one thing that's really useful for this style of investing is that it works for so many different kinds of companies. So I took out some of the even more impactful companies in this version. But when I pitch it with the company that sets up toilets in Kampala, there's usually a table that goes, oh my God, we need to make that happen. We'll do a loan, we'll give a 3-year honeymoon, and we want 4% of the revenues and 1.2 times or 1.3 times our money back, something tiny. And in the same room, there'll be someone else who's like me, who's a market rate impact investor, who'll say, I want 2 times my money back, and I want it back in 5 years, so I need 9%. And I want equity because there might be upside on whatever company I'm thinking of. And so we'll get that diverse of an answer. And what's really fun about this is those are both, they're just revenue-based deals. And if you guys haven't noticed, because I haven't pointed this out, the cash flows are identical between debt and equity. You hand money to a company and they're promising you back a certain percentage of revenues. Sometimes it's called a loan and sometimes it's called shares, buyback of shares, but it's in fact the same exact cash flows. And there is in fact a third version of this, which is usually used, the place I've seen this used the most is gigantic deals, multi-million-dollar deals, including growth stage companies and films and oil wells and mining, which is where it's most common. which is just plain royalties. So I will take 5% of all your sales until you've paid me back twice what I gave you, and I'm going to give you $5 million. You're going to pay me back 10 or $15 million off the top of the deal. Common questions. So moving on to questions. Common questions I get in this space is, why is it revenues? Why isn't it profits? So I didn't see that in the chat window yet. And so put in your questions in the chat window. And the answer on why revenue versus profits is pretty simple. If you think about your P&L, imagine a P&L in your head. We can all agree, the investors and the entrepreneurs can agree what that top line revenue number is, right? They're going to report it, and we might have some trust issues we'll get past in terms of believing it. But that's a number that everybody believes. That's the amount of money that came into the company. We can always check bank statements if we have to. Everything below that is out of the control of the investors. Even if I have a board seat, I can't control what they spend on the cost of goods. I can't control the vendor costs. I can't control, whether things were pre-purchased because they got a good deal on them. I can't control how many people work for the company in the expense line, or what the rent was, or whether that next conference was a good idea to go spend your marketing budget on. I have no control over any line below the top line. And so if I agreed as an investor to take a percentage of profits, then we're setting up this investment relationship to argue about every single line of the P&L from now going forward. And I've seen this done with profits. It was tried once, and then it was unwound because it became untenable, not because of that specific issue, but the next issue, which is something came up. So they agreed to what the budget was, and so you see some covenants about this in preferred equity. The company can't make a purchase more than X thousands of dollars without approval by the investors. But what usually happens in early startups is opportunities show up. If only we do this, we'll grow even faster. But if you've agreed upon a budget, you got to get approval to go do this, to go do X, whatever X is. And then if you have your investors that are expecting a percentage of revenues, and you're going to percentage of profits, and you're going to push profits out a few years in order to go and grab this opportunity. Great, now you're renegotiating this investment over and over and over again. Whereas revenues are good. Everybody likes more revenues. When the company announces that more revenues came in, everybody applauds, and the investors go, great, I'm going to get paid back more this quarter. And if revenues are low, everybody gets around the table and says, crap, why did the revenues come in so low? How do we make them bigger again? And with or without this style of investing, that's what happens in the boardrooms. And so this style of investing with revenues as the share aligns everybody's interests from the time it's gone and going forward. So that's why we like to do top line revenues. The other pushback that we often hear, which is kind of related to these honeymoons, is, but the companies need the money. Like, companies need money to make money, and you're sucking the money out of the companies. And the answer to that is yes, we are. And so is the landlord when we have offices again. And so are those employees. Usually that's most of the money. Those pesky employees are taking out all the money that I beat my head against the wall to raise. And those vendors want money. And everybody wants money. Everybody's getting paid as this startup gets started, except the investors. And so why is that? Why is the investors a special form of vendor that doesn't get paid? And so my answer is they should be. You're renting their money. That is what an investment is. It is renting capital. And they should get paid, just like the landlord is renting you space, and the cloud provider is renting you computers, and everybody else is renting you stuff. Well, pay the capitalists. They're renting you their capital. And if that means you need a little bit more, so be it. So raise the money you need in order to get the company going. You're not paying them back with their own money. You're paying them back with the revenue, percentage of the revenues you earn from customers. Customers dry up for some reason, like you got to pivot and whatnot. Well, then the payments to the investors dry up as well. That seems fair, right? The capital is there to find customers. If there's no customers, no payments. Right. And then John asked, while we were finishing up the piece to explain what's been going on with this. We've done, I think it's 100 of these now. It might be 101 in the past 8 years. I just did a talk for my investors at the Angel Accelerator, and I shared it with my fledglings. We talked about all the failures that have been in the system at Fledge, all the failed fledglings. And we started with Fledge 1 and the 7 companies that came into the first cohort in 2012. 5 of them are dead. One of them is doing great, paid us back ages ago. One of them just finished the put option end of last year. We made 4.4 times our money back on that deal. That company never raised another dime, turned down every investor. We introduced them to a lot of VCs. They decided they didn't want to be a VC scale company. They were happy growing as a bootstrap company, and now they own 100% of their company, and we made 4 times our money back, right? And that was about the upside part, right? They grew pretty well, bootstrapping. Our put option was worth more than the capital we gave them. Cohort 2, I think there was 1 company left. They're mostly done paying us back. Cohort 3, there was like 1 company left. Basically, bottom line is, in our early sessions of Fledge, almost every company that came in was idea stage. Idea stage companies often die. Most of ours did as well. We have had very few failures since Fledge 5, but Fledge 5 was about 4 or 5 years ago. So it's not, we haven't had enough time with revenue stage companies to tell you how long it takes to get paid back. Our estimates from what we're seeing in the cash flows is 7-ish years. 7 plus or minus a few, depending on how fast they're growing. And if they get more funding past our initial round, which happens a lot of times, but not every time, then they grow faster, right? Most of the time. And so it's going to take a while. When I have the numbers, I will be publishing and screaming them out. Shala asked, did we ever use anything as a honeymoon trigger? I don't do honeymoons. So as I said in the other rant, I don't like putting honeymoons in the terms because you really don't know what to put in there. We've tried to, I've worked with other investors that do honeymoons, and it's just really hard to know in this moment, especially this moment, but let's just call it in 2021, if we're sitting around post-pandemic and we're thinking, well, how long should we give them? It's just it's way easier to say, just start paying us. It's a small amount now. It's way more later. If we're going to look at 7-year paybacks or 8-year paybacks, the first year of paybacks really doesn't make a difference. It's a tiny amount of money. And I would, again, much rather get to that first quarter payment. And I've done this again, over and over and over again on purpose. Get to that first quarter repayment and tell them, you know what, let's wait a quarter. And I might do that twice. And that, again, is part of our relationships. All of a sudden, they look at us as an investor that just loves them because they owed us money and we didn't ask for it. Like, we told them to keep it. And so we get a bunch of hearts, where we get some positive feelings from our investees for doing that. And we gave up a little bit of money up front, right? But hopefully it makes them grow faster, and we still have that other half of the investment that makes it bigger later. So we actually balance that upside piece with the repayment piece. Okay, Zahar asks, is there a minimum threshold that makes sense for this type of financing? It's an awesome question, because what I've learned from doing this over the years, so we've done this for the follow-ons as well as the Fledge $20,000. So from all these follow-ons, we've done, I don't know, 3 dozen of them, probably 3 dozen or so. What I've learned from doing the analysis with this spreadsheet that you guys all now have, there's too much money. There is, in fact, if you sit down and you can't find a set of terms that look right for 5 or 6 or 7% of revenues, they're probably asking for too much money. That, if you then have to go back to the spreadsheet for that left column and up their revenue potential to make it work out. which is kind of telling you that they're asking for more money than their revenue projections are actually going to generate. And that's true, not just for revenue-based finance. This is the kind of the big aha here. But I have a second tab, which there's a second tab in that spreadsheet called traditional loan, which is just a loan repayment thing. Just seriously, just traditional loan repayments. But when you plug in the numbers there, you'll see what the fixed rate payment would be. So it's sitting there right now. $350,000 over 10 years is a $69,000 annual payment. So if you think of a company that's earning $500,000 a year and they have to pay $70,000 in interest, that seems pretty expensive. Kind of makes it feel, from the investor hat or the entrepreneur hat, maybe $350,000 is a little bit too much for this company. That it's really dependent on those later years of getting to $3, $4, $5 million a year of revenue to actually merit having $350,000 in investment now. And then if we go back to the old paradigm, the existing paradigm of preferred equity, well, the same thing's true. So if we're going to do this deal and it doesn't pencil out in revenue-based terms, where's the assumption that says some investor is going to pay 10x for this? If you can't get 2x out of it, why would some other owner sometime within this time frame of 10 years, why would they pay 10x for it? That makes no sense. And so simply from taking 5 minutes of looking at what the revenue-based return would be, you can kind of get a feel for how much money the company should actually be raising. And so I didn't think of that way back when I started working with here, but now it's something I do as a common tool. All right, John asks, is it really about margins? And the answer is yes. So if you're asking for 5% of revenues, what you're really asking for is 5% of the net revenue at the end of the day, right? The net margin at the end of the day, net margin percentage to be precise, you're taking 5% of the total. So you're taking 5% off of both the gross or the net, either one. But if you think about the net is the most important. So if they're netting out at 15%, right? If it's a real company with moving real items around, an atom-based company, not a bit-based company, they may make 15% net margins. And if you're asking for 5% of that, then you're really asking for a third of their profits. And if it's a food and ag company, if it's especially a farming company that's only making 7, 8, 9%, you can't ask for 7, 8, or 9% because that's basically all their profits. And on the software side, if the net margins are 25, 30%, you can ask for more. You may be able to ask for 7, 8, 9% of revenues, and it could still make sense. So yeah, margins is one that I always track as someone who understands how businesses run on numbers. But in terms of revenue-based finance, yeah, it really is a percentage of those margins. And I am out of questions on here.
Are there other questions that people want to chat? So one of the things, please put them in the chat, and I'm going to ask some or talk a little bit with Luni. So one of the things that we do is that we follow some SEC exemption to be able to write this deal term, right? And so we're engaging in the process of some pathway past the registration requirements. And so when you do your investments in Fledge, which exemption are you using?
So we're not using any exemption. We're the investor.
Right, but
what are the companies?
Yes, thank you.
Yeah. Okay. The most common is just the old-fashioned Reg D 506B.
Okay, so that's
the letters
classic angel, accredited investors only, private solicitation pathway where 92 or 95% of outside angel investments go through. Have you ever done
and then
Reg D 506C, which is the general solicitation pathway?
I have never personally done that. I have invested in companies that have done that, and it's a pain in the ass for the investor. because now there's an extra requirement of proving you're accredited, which isn't hard. It's just something that investors don't have to do. And it's not as easy as checking a box. It's something else that gets in the way. And I don't know anybody who's not made the investment because of it, but I know people who complained about it, and some in this group, in fact, I saw today, who simply complained that it was just a pain in the ass,
Yep.
Literally.
And so then we have like a dozen other exemptions, right? We can do a Reg 504, which is the intrastate exemption, and do an intrastate crowdfunding exemption, or we can do a Reg CF, which gives us a pathway to crowdfunding. And so,
which apparently is also just as Shala posted, the WeFunder path, which is Reg CF, is a pain in the ass as well.
Right. So
we've had fledglings go and raise money on WeFunder.
WeFunder is interesting because they do two at once, right? They do a Reg D 506C at the same time that they do a Reg CF. And so you can get accredited investors, and you can get a different class of stock for unaccredited investors. So people with more than $1 million can go in one pile. People with less than $1 million net worth can go in the other pile. And so WeFunder and Mainvest both do this same kind of thing. So there's options in terms of the pathway, but you're telling me that it's a pain in the tuchus. So
I love it when you use the Yiddish. I haven't posted anything on WeFunder, but I've had graduates that have gone and raised money on WeFunder.
Right.
And so on their end, it was great. We got money.
Right.
And their cap table's a mess now, but they're not going down a VC path. So
right.
No one's going to complain about that.
And so
Adam asks, hold on. Adam asks, do you run into problems with breaking the qualified small business stock exemption? There's some wording in there about redemptions, but we have not got to, I've not got a legal opinion on whether or not our version of redemptions is the same as the wording in that exemption or not. I need to do that this year. No, I need to do that next year. Anyway, I need to do that. It's on my list of things to do.
So in the process of doing this investment mechanism, there's a deal term on one side and there's an offering mechanism on the other. And the offering that you were alluding to comes from the company. And so the company has to file somewhere that they're going to do something. And sometimes they have to file before they make the offer. So they have to make the decision before they make the offer. And sometimes they can file after they've made their first sale, right? So there's some kind of fuzziness in that pathway, right?
I like the history lesson here. The stock market crashed. The public stock market crashed in 1929. And so the result of that is that you can't just sell shares in a private company to anybody you want. The logic in there is lacking. There's a big leap of logic in there, but that's the reality of what happened. And so it is illegal for a company to ask any random American to invest in their company, except there's a bunch of exemptions for them to follow. And so the normal path is only talk to rich people, people who are accredited, people or institutions that are accredited. And if you go down that path, you file a form, your lawyer files a form with the SEC. And that's the way venture capital's worked since that exemption existed. And that's the normal path for almost all the capital. You talked about 504. I've actually done a 504 offering before. I've done that with my nonprofit. That was a really easy path. In the state of Washington, you go and fill out I don't remember what the term that the form is. You go and file 2 forms with the Department of Financial Institutions on paper, and you send them a $60 check on paper. They don't take credit cards or wires or anything. And about a week later, they say yes, because it's a very short form. And then you can raise up to $1 million from any Washington resident without filing any other paperwork. You can't advertise it. It's still no solicitation. But you can get a bunch of people in a room who are Washington residents. And you can take their money, up to $1 million. 25 of them can be unaccredited and the rest are accredited.
It's a score offering.
No,
Not score.
504.
Well, score is.
It's a 504 intrastate offering. I can get you the link off of the DFI website.
So the dfi.wa.gov website is the place that has all of this stuff at it. And so it's worth taking a look at that. And no, it doesn't apply to nonprofits only. It's a path for any company to come in and take money in if you want.
Yeah, Washington is a strange state. 48 states, nonprofits can just raise money. Washington and some other state, we can't. I happen to run a nonprofit as well. And so we have to, if we want to raise money, we have to go and file the same process. But we're a Washington nonprofit and the investors are in Washington. So the easy path was this DFI path. I think I've used it 3 times. Cheaper than any other path. Score offerings are way more complicated.
So score offering is the one that has the fill out the form and make it go.
Yeah, but it takes 3 months to get the form filled out and approved, and then you can't talk about the future in that path. You can only talk about the past. Right. It's really complicated and rarely used. In this other offering, it's basically like a 506, but just in the state. And instead of paying, just the SEC filings was like $1,000.
Right.
Right?
So I put into the chat
the
DFI fundraising link so people can look at that and explore the intrastate things. There's pathways there, including the intrastate crowdfunding pathway that Joe Wallen put together. What I'd like to do now, unless you have questions you want to ask the audience, is to break up and mingle because we've stopped getting questions. Do you have any questions for the audience?
No, I'm good with the audience.
Okay, cool. Is there any events you want to tell them about?
So we'll run another, the one that's probably most relevant to this group is we'll run another startup accelerator when we can, when life gets back to normal. And we'll start another angel accelerator at the same time, simultaneous to that, when life gets back to normal. We don't plan on a second one virtually. And for those of you who've done SAC 1 or 2 or 3 times before, this is supposed to be the next step for you. This is a way to learn the next wave of investing and the next bunch of knowledge and start building that 20 company portfolio. So with one check, you can get to a 15 or 20 company portfolio.
Right. So thank you so much for doing this. I appreciate it. We're going to take the recording and put some goop on the ends and put it on our YouTube channel. I put the YouTube channel into the chat. I hope that you will keep coming and engaging in the conversations as we go through due diligence, term sheets, cash flow projections, and so forth. And I also hope that you come to the AMA event on July 21st when we get all the angel groups in a room and talk about what they mean by angel investing. So thanks.
That sounds fun.
And what I would urge everyone to do is to move around the tables and talk to people and engage in learning about who else came and what they're working on. So I'll end now and I'll visit you at the tables.